Welcome back to the channel, folks. This is Jason, host of Fighting Words Financial, and today in this video, let's talk about the 10 most common investing mistakes, part 1. Okay, folks, a little bit of background. I've been in the financial industry for almost 20 years, and I've seen pretty much all of these mistakes, but I wanted to talk about some of the ones that affect me personally and some of the ones that I've actually experienced and that have led to other mistakes. So I'm going to jump right into it right now. And here it is, folks, my top 10 list of investing mistakes, but in no particular order. This is for folks who are self-directed investors. Now, I am assuming that you're already smart enough not to fall for the biggest mistake of all, which is excessive fees and commissions, and usually that happens by working with the wrong advisor. So let's go. Number 10 is not having clear investment goals. Investing is like many other things in life. If you don't have a plan to succeed, then by default, you have a plan to fail. Try to decide right now, or at least relatively soon, what are your actual financial objectives? What are your investing goals? Are you a long-term investor? Great. If you're a long-term investor, then it's actually going to be relatively easy to design an investment portfolio that has a high probability of achieving your long-term investment objectives based on your individual financial goals and appetite for risk. Unfortunately, most people aren't actually long-term investors. They are really just traders. Too many traders focus on the latest investment fad or focus on maximizing short-term investment return, which makes it a lot harder to have clear investment goals and usually results in not maximizing returns over time at all, and usually results in vastly underperforming long-term buy and hold investors. That is not to say that all short-term traders will always underperform, but in my experience, that's the most common outcome. But to be successful, all short-term traders, at least the ones that I know that are successful, also need to have clear investment goals in order to develop a clear personal investment policy statement, a plan, in other words, with rules. After decades of experience in the financial industry, particularly with options trading, I can say that without a clear plan, a set of inviolable personal trading policies, you will fail. My advice to you, whether you want to be a trader or a long-term investor, is to write down on paper what I like to call a personal investment policy statement that clearly marks out every investment's risk tolerance, time horizon, the max loss you are willing to suffer, and the circumstances and conditions that would require you to sell. That is how I advise that you avoid mistake number 10, which is, of course, not having clear investment objectives. Number 9 seems to be something that is just inherent to human nature, and that is chasing returns. An investment that has performed well in the past is really a seriously seductive thing. It makes a lot of sense, right? An investment that's performed well in the past is likely to outperform an investment that was poor in comparison, right? Wrong. It's actually simple. Based on now hundreds of years of data from tens of thousands of investments, past returns are no indication of future performance. Now, on most of the investment literature you see, that is written all over it, and then they dive right into past performance. You really do need to remember that past returns are not an indication of performance whatsoever, and that is actually backed up by data and research. It's actually very natural to think this way, though, that what worked in the past is going to work in the future. Our silly hunter-gatherer brains are just evolved to think this way, but in terms of investments, it's not even remotely true. You can look up something called the SPIVA Persistence Report put out by Standard & Poor's twice a year, and in that report, you'll see that in any rolling 5-year period, whatever was the best performing fund in the previous 5 years is almost guaranteed to be in that bottom quartile of performers in the next 5 years, illustrating my point that investing in the past and chasing returns doesn't work. This is what the data tells us. The reverse, unfortunately, isn't true, that the worst performers are going to be the best performers. Of course, that would make investing too easy. So no, the thing to remember to avoid this trap is to always remember that you are not investing in the past. You are investing in the future. No, the thing to remember to avoid this trap is to always remember that you are not investing in the past. You are investing in the future. What worked in the past will never work exactly the same way in the future, because the only constant in life and investing is actually change. Things will simply never stay the same. Number 8, timing the market. And this is another big one, folks. Trying to time the market kills returns. Successfully timing the market is extremely difficult. Even professional investors fail to do it successfully, and the vast majority of them don't even try. Trying to be a market timing genius can really be your undoing as an investor. The best illustration of this is a series of research called The Best 10 Days of the Market. Go Google that phrase at the end of this video. I deleted my video on that subject because no one watched it. And even though the research proves that this is one of the most important lessons you can learn about investing. The initial research showed that an investor that was out of the market during the top 10 trading days of the S&P 500 between 1985 and 2005 would have achieved a return of 3.6% annualized instead of 11.8% by staying invested. Now, that investor only missed 10 of the best days out of a 20-year period. That's amazing. The research also amazingly showed that 8 out of the 10 best days occurred within a 10-day period of the worst days of the market in that same 20-year period. If you want to time the market, you have a really tight window, which I think requires a lot of luck, and only an average of 8 times in a 20-year period to get it right. This research has been ongoing now since 2005, and in every 20-year rolling period, the results are frustratingly similar. And this difference in returns strongly suggests that investors, no matter who they are, can't time the market and are better off contributing consistently to their investment portfolio. It would seem that no one has any special talents, no marketing, timing superpowers, and that feeling in your gut is just irrationality. Trying to trade in and out of the market in order to time the market is statistically a waste of time and almost certainly a waste of money. Don't believe me though, go and Google best 10 days in the market for yourself and you'll see that various companies have done this research and they've all come out with similar results. You can avoid this very important mistake by realizing that you aren't special, you don't have any superpowers, and you can't predict the future. Number 7, falling in love with a company. Boy, am I guilty of this. Tesla. Too often, when we see a company that we're invested in doing well, we eventually start to believe that they can almost do no wrong. That is until the CEO gets a Twitter account and starts posting a bunch of asinine things that affect the share price. It's easy to fall in love with a top performer in your portfolio and forget that we bought the stock as an investment. We aren't married to it and we should have no emotional attachment to the company because trust me, it does not love you back. Always remember that you bought this stock to make money, and if any of the fundamentals that prompted you to buy the stock significantly change, you need to consider selling that stock. You can, of course, avoid this particular mistake by being a lot less emotional. I suggest you go and watch a lot of reruns of Star Trek and figure out how the Vulcans avoided being emotional. That's what I do. Number 6, focusing too much on avoiding taxes. I'm also very guilty of this. Wait a second, can you be very guilty of something as opposed to just a little bit guilty? Or is it kind of like being a little bit pregnant? There's no such thing, you just are. Well, in any case, I just am. I have a pathological aversion to paying taxes, and I will use every legal method to defer or delay paying them, which can lead you into making several other investment mistakes that are going to appear in part 2 of this video. This focus on tax avoidance can absolutely cascade into other mistakes. This is actually a lot more important than it might appear on the surface. Be sure to watch part 2 of this video to find out why and find out how this has affected my own personal portfolio. Making investment decisions on the basis of potential tax consequences is a bit like the tail wagging the dog and is also a very common investor mistake. You should be smart about taxes. Whether or not you have to pay a large capital gains tax should never be, though, the sole reason that you hold on to an investment. Every part of that decision-making process should consider the fundamentals of the investment in a holistic manner, with taxes being a part of that equation, but certainly not the sole consideration. Knowing that fundamentals for an investment have changed and it's time to sell, even if you have to pay taxes, can vastly improve the overall performance of your portfolio and improve your return significantly. Tax loss harvesting can also improve your return significantly. But it's important that the impetus to buy or sell a security is driven by fundamentals in a holistic manner and not its tax consequences. I need to tell myself this more often. All right, folks, come back for part 2 of this video. where I go over the second half of the top 10 most common investor mistakes. Let me know in the comments if you think I forgot something important or if you think I'm full of it. Either way, the YouTube algorithm likes comments. Don't forget to like, subscribe, and click the bell for notifications. Thank you very much and have a nice day.